Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with my colleague, Allison Schrager. She's a senior fellow at the Manhattan Institute, and our special guest today, Nick Colas. He's co-founder of Data Trek Research, a newsletter that we all love to check out in the morning, first thing in the morning. So we're here to talk about non-farm payrolls, the unemployment rate. It's sort of a big day. It's a day that's likely to get a lot of conversation because we're going to get these benchmark revisions. There's an expectation that we could see December 2025 payrolls revised down to the tune of, almost 1 million jobs, right? So that's likely to generate a lot of conversation, not just in econ world, but also potentially in politics world. The key number, though, I think, really focusing on what's going on today is going to be that unemployment rate. The expectation there is that will stay steady at 4.4% from a previous 4.4% in the month of December. Nick, let me send it over to you. We're going to get a lot of information here. Where's the signal going to be for you?
For me, the signal is going to be in the unemployment rate, like you just kicked off with, because the rest of the data has gotten very choppy, very revision heavy, and only the unemployment rate seems to be stable enough to think about where policy might go. So if it drifts higher, I think that puts pressure on the Fed to cut rates sooner. If it drifts lower, it kind of signals that we're still okay. So that unemployment rate's going to be, I think, for me, the most important number of the series, followed by the revisions to the jobs creation numbers over the past couple of months.
Okay. Allison, what about you? And how are you thinking about the dynamics over at the Federal Reserve? Because, I mean, we're in this very funny period. It's the end of the Jerome Powell regime, so to speak. There's a lot of open questions about inflation and jobs. What could actually move the needle for the direction of monetary policy here?
Well, as Nick pointed out, if we do have an increase in the unemployment rate, then that justifies, but it does have some credence that Powell's been not aggressive enough cutting rates, and the labor market is weakening, and he hasn't been as responsive as he could. He'll be in more of a bind. It's sort of a fun week because we've got CPI on Friday, where if we still as well see inflation sort of stubbornly around 3%, and suppose we have unemployment ticking up to closer to 4.5, then, at that point, it's sort of unclear, what direction it goes in. And if I were Jay Powell, I'd just be relieved I don't have to do this anymore. But I also as well want to give some attention to the labor force participation rate, which is always my favorite statistic, because, I think that also can capture people who are discouraged, especially this concern with younger people having a problem finding a job, maybe finishing college and just not trying. So that will also sort of give us some sort of indication of, how discouraged are people. If it is indeed true, the statistics do bear this out, that it's not, the unemployment rate looks okay, but the job finding rate is definitely kind of elevated. It's harder to find a job.
Yeah. Nick, I do want to ask you, so as I said, we're going to get these benchmark revisions. How much time are you going to spend worrying about them? I mean, it is a bit of a look in the rearview mirror. Does it tell you anything?
It doesn't tell you much from a trading perspective or investing perspective. It's interesting statistically, and I think more than anything, it tells us that this whole data series has lost a bit of its importance, or at least a little of its day-to-day relevance in terms of trading capital markets, because these revisions come along once, twice a year, and they really restate what we thought was the truth. And this didn't used to be the case anywhere near as much as it is now. So it's kind of devalued these numbers to some degree, but we have to still trade them as we see them. So it's a bit difficult for me. This is not your, the jobs report from 10 years ago, which was statistically, I think, a lot more robust.
All right. Well, we've got just about 10 seconds, 15 seconds till the number. Just a quick market update. We've got the 10-year yield at about 4.12 going into this, and we'll bring you the numbers when they hit. So let's see. These should be populating now. So you get an upside surprise, and the change in non-farm payrolls comes in at plus 130,000. The change in the survey had been for 65K. So we create twice as many jobs as had been expected. Let me take you, though, to the key number. The unemployment rate comes in at 4.3%. That's 4.3%. So we're actually stepping down in this key number for monetary policy. 4.3%. The expectation had been for a 4.4%. I'll quickly take you through a few of the other headlines here. So your change in private payrolls, again, your change in non-farm payrolls overall, including government, had been 130K. Your change in private payrolls comes in at plus 172K, right? So the job creation is coming from the private sector. Always good to see. Month on month, seasonally adjusted average hourly earnings comes in a little bit warmer than had been expected at 0.4%. But your average hourly earnings year on year, bang on 3.7%. Average weekly hours, actually a little bit stronger than had been expected at 34.3. And then your labor force participation rate, I know a favorite of Allison Schrager, 62.5% for the month of January. So all in all, this is looking like a positive surprise. Nick, let me go to you first. What's your snap reaction here?
I totally agree. This is a nice report and kind of what looks like a clean report. Revisions on the lower side of things, definitely an upside surprise to job creation. Definitely a nice little decline in unemployment rate. Looks very, very solid. And, wages still up 3.7, I think the number was. Trending a little bit lower, but so in the right direction for the Fed, but still quite strong. So color me surprised, color me happy. I like this report.
Yeah, is this from an equity market standpoint, though? At the end of the week, do we look back at this as a good news report? Because a lot of, at least some of what had been driving the equity action was expectations around the 10-year yield. We now see the 10-year yield popping back up to 4.19% on the back of this report. How does the equity market read this, Nick?
Oh, it's good news, bad news there. You're right. The 10-year has been a bit of a sore spot, and I think it's been helping more recently, so that's great. But I think we also have to put this in a longer term context, which is, one of the underlying worries that the equity market has is that AI is going to replace a lot of jobs fairly quickly, and particularly, in particular, raise the unemployment rate, I think, more than it would want to see. And this report says that narrative's not quite there yet. So take your point in the 10-year, probably the most important market action today. But as we look back on this and future reports over the course of the year, I think we're all going to be looking to see and make sure that we're not seeing a major disruption in labor market demand from AI, the way a lot of companies have talked about. So I view it as a 50-50, bad for the 10-year, therefore bad for stocks. But I think we also want to see this economy continue to hold steam, and it is doing that based on this report.
All right. Allison Schrager, how should the Federal Reserve be thinking about this? The waning days of the Jerome Powell administration. There had been a lot of concerns going back about 6 months about the risks to the labor market outlook. Some of those risks don't seem as risky as we might have thought in light of today's numbers. How do you think the Jerome Powell the Jerome Powell led FOMC is thinking about this number here, Allison?
I think obviously everyone's always happy when there's a good employment report. I mean, that means people have jobs. That's always good, obviously, on a human level. But also, I think for this Fed, as I said, Jay Powell can now go out and be like, we had this high inflation. got it down. Unemployment was in good shape. The president was bullying me to cut rates. I didn't think it was the right thing to do. The data suggests it is not the right thing to do. So he gets to sort of not look like he was yielding to political pressure, stayed the course, left the economy on a high note. You know, I think this sort of data sort of does, you never know. I mean, it's month to month, things vary, but it does validate the view that we're gonna have a bit of an economic boost this year, maybe from all the fiscal stuff, maybe just from less tariff uncertainty. And, this is an economy that just sort of wants to grow. But if I was Kevin Warsh, I would be more concerned, because if this keeps up, we could see a big uptick in inflation later this year, and he could be under a lot of pressure, at least from a policy perspective, to increase rates. And I think that's going to definitely put him in a political bind, because, he took on this job promising to cut rates. So it's good for Jay Powell. I would, I'm not going to say Kevin Warsh is rooting for a bad jobs report, because no one wants people to lose jobs, but it definitely will make his job harder.
Yeah. Well, I want to come back certainly to what you said there about about inflation, but I want to go through real quickly the composition of these 130,000 jobs that we added to U.S. payrolls in the month of January here. Just real quickly, you see a strong contribution from construction, noteworthy. I guess always worth looking under the hood at that figure. That's specialty trade contractors is where that construction contribution is coming from. Let me scroll down here a little bit. So manufacturing payroll growth is positive for the first time in a while. We do continue to shed jobs in trade, transportation, and utilities, information, financial activities, but professional and business services does end up being a positive contribution. And here's the thing that really moves the needle. This is interesting. Education and health services, 137K. This is particularly interesting to me, because this is the sort of acyclical part of the non-farm payrolls basket that had been holding us up for a long time. There was some speculation that it was maybe slowing, but boy, does it pop right back up there in the month of January. And just to get into that, where is that coming from? My goodness. So healthcare and social assistance. Yeah, big hiring in the month of January in healthcare. So there you go. I mean, to me, that is going to be an asterisk to some people, and justifiably so, because healthcare is not it's not typically the thing that you see booming in an economy or a labor market that is firing on all cylinders. Nick, does that give you a little bit of pause as well? I mean, job creation is job creation, but composition could be a little bit better. Do you think? Is that a fair statement?
It is a fair statement, but we also know that that particular category, anything related to healthcare, has a very strong demographic tailwind. So I don't think we should begrudge it too much. I mean, it's certainly chunky. It's a very lumpy month-to-month comp, but we do know that's a valid demographic, long-term social trend to we're needing more healthcare workers. So I wouldn't put too big an asterisk next to it. I think the construction data was interesting, because we're all looking for data center construction as a major source of GDP growth and of labor market growth, and we're getting a little bit of that as well, and that gives me some cheer as well.
Yeah.
Do we see what government jobs? Because last time it was poor because we, lost a lot of government jobs. Are we seeing people being reallocated to that? Is the government hiring again?
Yeah,
still down.
Thanks for bringing that up. Yeah, it's still down to the tune of 42,000. Now, let's see. Within that, though, most of it is federal government. There you go, and some state as well. So that you can this is a little bit of a choose your own adventure, right? If you wanted to be positive on this report, you say a lot of this job creation is coming from actually all 100 and something percent of the job creation is coming from the private sector. Pretty good, right? There's some dynamism.
Yeah, away from government towards private sector. I'm not sure if you're a federal worker, that means you can become a nurse in a month, but
takes a little while, right?
Also, like, I'm curious about business services, because I guess that would be maybe where AI is showing up, and that seemed like kind of a mixed bag too.
Yeah, let's dig in there. Why don't we? So let's see. Professional and business service. This is always such an interesting category because it gets sort of stereotyped as the white collar category, but it's more complicated than that. So you get some strong growth from professional, scientific, and technical services. What does that mean under the hood? You have some growth in legal services, architectural engineering, management, scientific, and we have such long titles on these things. I got to talk to the people at the BLS about this. Management, scientific, and technical consulting, registering some growth, and the very specifically named other professional, scientific, and technical services expanding by 8,000, which it's a small number, but it looks like there's some kind of size and scope on that actually. So
AI adoption, but no real job loss from it yet. It's like it's the story there.
Yeah, I mean, people always say that legal services, for example, paralegals are going to be victims of this revolution, but not in the month of January 2026. Anyway,
early days.
One step at a time here. So, Allison, how should we be thinking here about this argument that we used to talk a lot about? That sort of, what we were seeing in payrolls was a weak labor supply story. There was this big debate when non-farm payrolls growth started sort of crashing in 2025, and people were saying, well, it's all about supply, it's all about the immigration story. This does sort of feel like clearly, 150, 160,000 jobs created is not spectacular by the standards of the U.S. labor market, but the proof is in the pudding. The unemployment rate is drifting down, or at least stabilizing, if you look at the arc of things over like the last 6 months. So I guess supply and demand are sort of still in that curious sort of balance that Jerome Powell described in a press conference not so long ago. How are you thinking about that?
Yeah, I mean, I think what we're seeing is an economy that equilibrated pretty fast. The labor force is smaller. I mean, we have fewer migrants, people are aging. As you said, like, this would have not been an outstanding jobs report in 2024. But, unemployment rate says something different just because we do have a smaller labor force. And so many things just stun me about the last year. I mean, as an economist, you always think you're going to have these shocks, be it like tariffs, be it this crackdown on migration, and you expect the impact isn't sort of as strong as I would have expected with any of this. Like, I would have expected having a much smaller labor force would have, had a bigger impact on the economy. But, well, I don't know why not.
Yeah, and sort of along these lines, I also want to point out another statistic that I've been curious about. So this is the time series for people working part-time for economic reasons, meaning they would ideally like to be working full-time, but their bosses have cut back on their hours. And we saw a spike in this in the sort of messy November report, and then it came down a little bit, but now it's back down. So this feels like yet another pretty positive sign that labor demand is not falling off a cliff here. So let me just put a call out to folks for send in any questions if you have any questions for Nick or Allison. We are happy to take them here. And just a quick rundown of the key statistics here. So again, we're talking about the change in non-farm payrolls came in at 130,000. That is twice as strong as the 65,000 that had been expected. The unemployment rate comes in at 4.3%. Allison, what's on your mind? What are the sort of unresolved questions here? Anything that you want to put to Nick?
Well, yeah, I mean, as Nick, I think, brought up a good point in the beginning, in that, these reports have become a lot noisier than they were before. So I think, the percentage numbers are very reassuring, but, I'm curious what Nick thinks is sort of, if we're going to expect sort of more of this year, or do you think that, this is going to be just another noisy report?
This is exactly what we're going to be facing most of this year. The underlying U.S. economy seems to still be in pretty good shape. And Allison, to your prior point, I mean, the most amazing statistic about the U.S. economy is that for the last 16 years, we've had 3 months of recession. That's it. It has otherwise been a growth economy for a decade and a half, aside from 3 months around the pandemic that got solved with fiscal stimulus. So there is something about the U.S. economy that has an underlying strength, an underlying resilience, which labor market data shows, like this month being an upside surprise. But I think we're going to see more of that. A little bit choppy this year, but an underlying strength to the economy that will surprise people. And that's ultimately the most important thing about these jobs numbers, is that they continue to be fairly robust. Yes, it'll make Kevin Warsh's job a lot harder, but that's a price worth paying if we get another good year in the job market, another good year in the stock market.
What do you think is driving that? Like, all the strength? Is it the innovation? Is it just people?
I think it comes down to the last 20 years, the whole post financial crisis world was about creating at a micro level, at a corporate level, a sense of resilience, a sense of stability, a sense that you have to bulletproof your organization and make it reliable, make it resilient. And that was the lasting lesson of the financial crisis. And it has ended up surprising people, certainly surprising me, as to how much of that ethos has taken over in corporate America. But you have a situation now where corporate profitability is at record highs. S&P net margins are 13%. And probably heading to 14% this year. So I think it ultimately comes down to just the private sector doing a very good job managing their business and allowing the economy to remain stable, when I think, as you said, because of the tariffs last April, I expected a recession. Most folks expect a recession. We didn't get a recession. We got 2 quarters of 4% growth in the back half of the year. That tells me things are very, very strong in the underlying economy, which is great to see.
So I was reading a column by Greg Ip arguing that this week that, the economy is growing, but most of the gains are going to capital rather than labor. And that's why we see the stock market going so up. And I mean, wage growth is nothing to sneeze at. I mean, real wage growth is positive. I mean, do you think what we're seeing is an economy in transition, and and we're going to see sort of some more of this divergence between capital and labor?
Tremendous volatility. Oh, I think my mic went off.
Mm-hmm.
I think what we're seeing is an economy that generated a lot of volatility over the last 5 years. If you look at the New York Fed SCE's inflation expectations for food, energy, rent, the volatility is off the charts, and it's that volatility that scares people, rightly so. So I think the underlying economy is fine, but I think the volatility around expectations is what makes it feel heavy.
Mm-hmm. Yeah, I mean, I think that you're right. There's this big risk, particularly for Kevin Warsh, if we do see this uptick in inflation. I mean, I guess Friday will be telling, particularly later in the year. I think Torsten Slok keeps predicting we're going to have this banger of a year. And I think what we learned, or had to relearn right after the pandemic is how much people really hate inflation, and how that could really sort of, even if we're having a growing economy, even if we have a low unemployment rate, that if inflation is going to get well north of 3%, people are still going to think that affordability is an issue. I mean, how do you think that we could end up in this sort of continuing joyless recession? Or do you think there's anything that's going to make people feel good about the economy and good about their situation?
The only thing that makes people feel good from here is lower inflation, and
Mhm.
reliably lower inflation. As I said, it's not just inflation that worries people. The affordability crisis is really a crisis about the future. It's about people being confident that inflation will be low, not just this quarter, next quarter, but for years to come. That allows them to budget, that allows them to plan. By the way, companies are in the same boat. So I think it also is just low volatility. Low inflation volatility matters. And we had a huge burst of it in 2022 and 23, and it needs to come down and stay down. Otherwise, yes, joyless recovery is a fantastic term.
Do you think it's inflation's like 2.7% ish? That's not that much higher than 2%. Do you think people feel that difference, or do you think they're just scarred from the earlier bout of inflation and just feel less security about it?
It's definitely the latter, less security. I mean, I'm old enough to remember all the inflation in the 1980s, and how my family dealt with it. I remember going to the supermarket with $20 and having to come home without the full shopping list because prices had gone up so much that we couldn't afford all we had on the list with $20. And that scars people for a long time. And that will be the case here.
So a lot of people, a lot of economists argue that Paul Volcker, when he just you came out of that by him just going hard on inflation, which gave everyone a lot of security that inflation was not something they needed to worry about, or at least people in markets. I don't know if the average person felt that way. You could probably tell me more. But do you think that people are still worried about inflation because they feel like there's not an adequate commitment to bringing it down?
I think people's lived experience is that there's still uncertainty about this point, particularly in food, particularly in rent, less so in gas because oil prices are down, but it's that uncertainty. It's not just, hey, we're 2.7% today. It's what's my rent going to be? What's my food bill going to be? Is my food bill going to be another 20% higher in a year? It could easily be. And what do I do? Because I'm not getting enough of a pay raise, even with these very good jobs and wage numbers to offset that. So it's that uncertainty about the next year that I think drives this malaise, for lack of a better word.
And let me ask you a question. Does it feel like the market is going to be sort of on pins and needles when this CPI report comes out on Friday, Nick? Because there's a pattern emerging. January has been absolutely brutal in these numbers. Economists call it excess seasonality, and there's a possibility, it seems, that since we had this big tariff shock last year, that the excess seasonality could be exacerbated even this January. Is this something that you think the market is primed for, and they'll get over it in 15 minutes after the headlines cross? Or is this something coming off the back of this strong jobs report that the fixed income markets in particular might potentially have a bad day or week over? What do you think?
Yeah, we've been struggling with this Q1 issue, and it's really a Q1 issue. Seasonality in the U.S. economy is brutal. Q4 is very strong. Q1, nothing's going on. It's wintertime. No one's spending money. No one's going anywhere. And so we've dealt with this issue for a long time. It's pretty well known. So I'd be surprised if the stock market was surprised by anything in the CPI number. It's a very hard thing. I mean, people don't really appreciate how volatile the U.S. economy is on a quarter over quarter basis, not seasonally adjusted. And so it's very tough to do the correct adjustments and actually make them stick.
I gotcha. Hey, we need to start winding down here. Just to recap for everybody, the key number that everybody wants to zero in on is this unemployment rate, which ticks down to 4.3% from a previous 4.4%. The expectation had been that it was going to hold steady at 4.4%. Behind that is this strong payroll growth, 130,000 jobs created overall, 172,000 from the private sector. So this is 100 and something percent private sector payroll growth here. Now, the market, which had been primed for a potentially weak number, is reevaluating what this means for monetary policy and other things. We see the yield on the 10-year Treasury note jumping on the back of this to 4.20%, roughly speaking. We had been as low as 4.12%. All in all, I want to thank everybody for tuning in. I want to thank Nick Colas. Thank you, Allison Schrager, for your comments and also for taking over amid some technical difficulties there. I also want to remind folks tomorrow at 8:30 a.m., please join us. Please join our politics editor, Sarah Green Carmichael. She will preview the swearing in testimony from top ICE DHS officials as that agency faces shutdown threats. And we will also be back for CPI Day on Friday to pull apart some of these complicated dynamics and help you interpret that excess January seasonality. So thank you again. My name is Jonathan Levin. Thank you, Allison. Thank you, Nick. And we'll see you all soon.